Let's do a deep dive into down payments. So what is a down payment? A down payment is simply the percentage of the home's purchase price that you are paying or bringing to the table through the closing process. Lenders will look at your down payment as your initial investment into your home. The size of the down payment has a direct impact on your loan terms for most loan programs. So, for example, if you don't do 20% down, most loan programs will require you to carry private mortgage insurance. In today's housing market, many buyers are choosing to do less than 20% down. The average down payment sits just over 8%, and for first time home buyers, it's less than 6% down. Let's quickly talk about the pros and cons of doing a smaller down payment, something more like 5 or 10% down. Long gone are the days of where a homebuyer usually will do 20, 30, 40% down to purchase their first home. Unfortunately, home prices are just far too high for that at the moment, especially when you consider the last 4 or 5 years of rapid appreciation. So, doing a smaller down payment makes it easier for us as home buyers to come up with the necessary funds to engage in a transaction. So on the left, I've created a list of pros of doing a smaller down payment and a list of cons on the right side, which we can go through together. So first things first, which is the obvious answer, it requires simply just less money if you do a smaller down payment. This makes it easier to save up for a down payment at a much quicker pace. Next, it puts less money at risk. So if you're concerned about the economy or a potential housing crisis, don't invest a lot into an asset where you have questions. Invest the minimum amount and allow the lender or the bank to bring the majority of the funds to the table. Last, it enhances your levered returns. So think of it this way. We'll cover more on this topic later, but think of it this way. If there's a $500,000 home and it appreciates at 5%, that appreciation is going to take place whether you do 5% or 20% down. So you could get the same $25,000 of appreciation by simply putting a 5% down payment or $25,000 down. The investment or the asset should and will perform exactly the same regardless if you do a smaller down payment or a larger down payment. Now let's look at the cons or the downside or the other side of the coin when it comes to doing smaller down payments. Put simply, a lower down payment means a higher principal and a higher interest payment simply because the loan is larger. So when we're financing more, it's really simple. Our payment is going to go up. Some people, it may be worth it to have a lower fixed payment and do more down. This is going to utilize less than a 20% down payment, requires the borrower to obtain and pay for mortgage insurance. So this is a fancy way of saying when you do less than 20% down, most loans require you to carry private mortgage insurance. If you have great credit, this is extremely affordable. And on most loan programs, like conventional loans, which are the most popular loan programs people choose to use, once you hit 20 to 22% equity, the private mortgage insurance falls away. Private mortgage insurance has become a lot less expensive since 2015 and 2016 as the housing market has become healthier and healthier when it comes to foreclosure rates. So what that means is lenders are taking less and less risk and insurance carriers are taking less and less risk of a default actually taking place. So again, if you have great credit, private mortgage insurance is very affordable these days. Last but not least, because of the higher monthly payment, your pre-approved shopping payment may be smaller. So if you're sensitive to your budget and you're trying to stretch the pre-approval as far as you can, coming up with some additional cash is going to give you that extra breathing room to potentially hit a higher pre-approval amount and increase your home buying budget. Next, let's cover the minimum down payment requirements for most common loan programs. While many buyers choose to do 5 to 10% down, you can utilize an even lower down payment if necessary. So, on conventional loans, which are by far the most popular loan option in our country, you can do as little as 3% down, especially if you're a first-time homebuyer. With jumbo loans or loans that exceed our county loan limits, think of loans closer to the $1 million mark, you could do as little as 10% down up to usually around $2 million. On an FHA loan, you can do as little as 3.5% down. And on USDA and VA loans, you can even do 0% down. More and more of us are choosing to do a smaller down payment rather than a larger down payment close to 20%. For first-time buyers, the average is just over 6%, and the average buyer in general is doing closer to a 8 or 9% down payment. Let's look why it may make more sense to do a 5% down payment compared to a 20% down payment. In these two examples, we're using a $500,000 house and we're comparing a 5% down payment versus a 20% down payment. When we look at the 5% example, it's easy to do the simple math and say our down payment is $25,000. If we get an interest rate that's slightly lower compared to the 20% down mortgage, we would have a monthly principal and interest based on a 6.375%. It would be a $2,963 monthly payment. Once we add our taxes and insurance on top of that payment, we have a total payment of $4,065. We got into a $500,000 house with our down payment of $25,000 and $8,000 worth of closing costs, so a total cash outlay of $33,000. Now, let's look at the example that is with 20% down. In this example, our total monthly payment would be $3,543, so it's a $522 monthly savings by doing 20% down. But we've had to do $109,000 down, which represents $100,000 of our down payment and $8,000 or $9,000 worth of closing costs. This is a difference of $76,000. So something to think about is simply, what is more important, right? $500 of savings, or would you rather have an additional $75,000, $80,000 in your bank account on a going forward basis? Simple math will tell you that if you simply invest the $75,000 into a high yield savings account that is crediting 5 or 6% today, over time that interest is going to continue to compound. And you are going to be able to make up, for most of us, the majority of that $500 difference. Now, if your goals and objectives are to have the lowest monthly payment possible and you have a lot of cash sitting around in your bank account, it may make sense to do something like 20 or 25% down. But for the majority of us, while there is high inflation and uncertainty on the horizon when it comes to our economy, it most of the time makes more sense to do less down. One thing that you shouldn't overlook when you're considering doing a large down payment compared to a smaller down payment is a lower down payment provides a lot of financial flexibility compared to a larger down payment doesn't necessarily provide that financial flexibility to you. For most of us, if we do a lower down payment and we have that cash sitting in our account, there is a level of comfort to that, and there is a very easy ability to tap into that cash and use it for something else or a different type of investment. Where if you do a large down payment and for whatever reason you may need that cash a year or 2 or 3 down the road, it could be a little bit problematic or expensive to tap into that equity. So from personal experience, I have a lot of clients and students that come back a year or 2 or 3 after purchasing their home, and they start to explore options on how to tap into that equity. So for example, if you purchase a home in Texas and then you want to cash out a year or 2 later, you're going to take a hit to your interest rate to be able to tap into that equity. And not only that, you're going to pay closing costs again to do a refinance. So if you're unsure of how long you're going to live in that home or what your goals and objectives are, or do you really need that cash, I would say for sure do a lower down payment. With a lower down payment, if you still have those funds in your account a year or 2 down the road, you can always take those funds, apply it as a principal reduction. The question I get after that is, Eric, how do I drive a lower payment though? What if I want a payment that's $500 lower? You could do what's called a recast. And a recast is basically you do for example, a $50,000 principal reduction. You pay the lender up to $300. They use the same interest rate that you had when you originated your loan or set up your loan the first time. And now they will solve for a new monthly payment based on the new principal amount. So again, if you're unsure or you're on the fence, I would tell you the honest advice I would give you is do a lower down payment and then figure it out a year or 2 down the road. You're going to be happy that you have that cash in your bank account rather than sitting with the lender. Before we move to how to come up with a down payment, I wanted to drive these points home for you. A story comes to mind. In the beginning of 2021, we had been working with a client for the last 6 months. They were very on the fence on whether they wanted to do a 5% or a 20% down payment. At 20%, it was a $150,000 down payment. Well, they decided they didn't want a higher monthly payment, so they went with a $150,000 down payment. 18 months later, lo and behold, we're in a much different interest rate environment. But this particular student was dead set on purchasing more than one home. And it was time that they bought their first investment property. So, what did they have to do? They had to cash out on the first property that they bought, moving their interest rate from 3.5% to 5%. And then they went and bought an investment property with an interest rate of 6.5%. So if you're on the fence, our advice is always to go with a smaller down payment. You can always take those funds and apply it as a principal reduction down the road. Last but not least, let's talk about leverage. If you purchase a $500,000 home, whether you do a 20% down payment or a 5% down payment, you're going to get the same exact appreciation. So in this example, with a $500,000 home, if we get 5% annual appreciation, I make the same $25,000 of appreciation regardless of what my down payment is. In fact, let's just say I did a 5% down payment compared to a 20% down payment. I can take the difference between the two numbers and go invest this money elsewhere. My money is properly leveraged. This is key. In the same example, what if I took that money, the 15% down, saved for 12 more months, and purchased an investment property with a 20% down payment? Well, now I've leveraged my money more effectively. I'm getting appreciation on a $500,000 home that I bought this year, and now next year I get to look forward to getting appreciation on my next home as well.